Hey guys, I am going to now run through the dollar index, which is a pretty important tool when it comes down to gauging the strength of the US dollar, especially if we're trading any currency pairs and even gold, which include the US dollar in particular. So on TradingView, the code, the symbol for the dollar index is DXY. Okay, and on this one, I do believe there is another one which allows us to go into the lower time frames, the intraday. However, to be honest, my method of using the dollar index and utilizing this graph, I don't look at anything less than a daily because I'm not trading this. I'm not looking for trade setups. I'm using it as a measurement of the US dollar, the strength of the US dollar, to see is there any major key levels? Is there a potential for reversal? Once more, we can actually use all of the technical tools on this chart. I'll go through the main ones that we really want to focus on and so on. So as you can see here, I do have key levels on that. I will get into that afterwards. Firstly, I'm going to pull up a quick breakdown of what the dollar index actually is. Now, I've sourced this simply from investing.com. Okay. Very, very clear, very, very concise. You can print screen this page if you will. So what is the US dollar index, USDX? So the dollar index is a measure of the value of the US dollar. So it's more or less the US dollar's value against a group of major currency pairs. So it's a measure of the US dollar relative to the value of a basket of currency pairs, which are the most significant and more or less strongest currency pairs in the world, and the ones that are most utilized. The index is similar to other trade-weighted indexes. So you can even get pound index, the yen index, and so forth, which also use the exchange rates from the same major currencies. Now, these currencies include, so breaking down the dollar index, so currently this index is calculated by factoring in the exchange rates of 6 major world currencies. 6 currencies overall, guys. So we have the euro, the yen, Canadian dollar, British pound, Swedish krona, and then the Swiss franc as well. So it's measured against these 6 currencies. It's a very, very handy tool, especially if we get our levels right and we can actually read the trend, and we're looking at, again, monthly, weekly, daily timeframes in particular. That is what I find the most beneficial. Ultimately, as stated here, the euro holds the most weight versus the dollar in the index. So again, the euro USD is in fact the major currency pair. It is like the top one. Okay, this constitutes for 58% of the weighting, followed by the yen. So most important is the euro USD, and then the USD JPY, the dollar yen. The index started, the history goes back to 1973. Again, we've covered this on the one-to-one course. 1973 was the time in which the gold standard was completely removed from the US dollar. So again, that's quite interesting because that is when this index actually started. And that is when the price of gold started to rally and started to rocket from lows of around $25. And obviously it's made highs of 1,929 a few years back. So every index has a base of 100. Okay, so if I look at the chart over here, 100 is the initial value. That's the initial value right here on this line, 100 of the US dollar. To simplify this, and this goes for the other index as well. If it's a pound index, 100 will be the same initial value. So let's say an index value, let's say the dollar index was trading at 120. That now suggests that the US dollar has appreciated 20% versus this basket of 6 currencies. So it is stronger by 20% of all of these currencies up here, the 6 currencies I've just gone through. So subtracting the initial value of 100 from the current value of 120 yields 20. So that's an appreciation of 20%. Similarly, if the index is currently at 80, let's say it's fallen, minus 20 from its initial value of 100, so it's trading at 80 now rather than 100, that is a depreciation of 20%. Let's look at the current price. We are trading at 92.5. That's a depreciation of 7.5%. 7.5%. Back in October, November 2016, it made highs of around 103.81. So that's 3.8% from the initial original value. So the key levels on here, I will break this down afterwards properly. But at the moment, dollar has been sinking for about 6 months now, 6 or 7 months. And it's depreciated 7% against the majors. And this is also reflected, obviously, in, if I can just pull up, bear with me 1 second. If I pull up the Euro USD, since the depreciation of the dollar index, look what we've seen on the euro. We started to trend, haven't we? You guys know who have been members for the longest, that we were in this consolidation zone. Euro started to pull up. When did it start? January, February, March, April. It found that base there. From April onwards, we had a strong April month, and it continued. 1, 2, 3, 4. So if we relate that to the dollar index, April here, this is when it started to decline. So can you see the correlation? Dollar index, we had the crossover, we had the break below the moving averages, we had a rebound from the moving averages, down, consolidation, down. So we can still use, especially the moving average knowledge that's further down in the course. I do recommend that you go through. Actually, to be honest, I'm going to put this section near the bottom. This is going to be one of the last sections. So everything you've gone through so far, especially the moving averages, can be used on here. Look at the candle formations, bearish engulfing over here. We've engulfed 1, 2, 3, 4, 5 previous weeks. Here we have a Maribozu. MAs are still down. Key levels, I'll get into that afterwards. But the correlation between the dollar index and the Euro USD is as follows. If we look at here as well, as the Euro was consolidating sideways and trapped between these two ranges, these two key levels making the range, sorry. Look at the dollar index, similar price action. It's obviously not going to be bang on with the major currency pairs, but as stated over here, the euro constitutes for 58%, so nearly 60% correlation with the Euro USD in particular. So it's very, very handy, especially if you are a Euro USD trader, to keep an eye on the dollar index going forward. I'll get into the technical aspects afterwards. Let's finish this off. So I hope that you understand that. So recap, if it's anywhere above the 100 level here, so 101, it's up 1%, 102, 2%, 103, 3%, 104, 4%. If it's down to 99, it's minus 1%, 98, minus 2%, 97, minus 3%, and so forth. We're currently down 7.5% because we are at 92.5. The history of the dollar index, so we've already mentioned that it more or less started to pop off from 1973 when President Nixon pulled the rest of the gold from the dollar in particular. So this came onto the scene once the US dollar more or less, well, the Federal Reserve had the power to now print as many notes and push as much money into circulation without any backing as possible. So that's when this dollar index actually came onto the scene. History of the US dollar index. The US dollar index has risen and fallen sharply throughout history, reaching its high point in February 1985 with a value of 164.72. So this there, that is a 64.7% increase against its 6 counterpart currencies back in 1985. So that's when the dollar was at peak strongest. Its lowest point was in March 2008 with a value of 70.69, so just over 30% depreciation. And again, June 2016, 93, we're kind of consolidating here now. So look at the chart. We're back to this level. So 93.67, we've actually just popped below that then. We're looking back here, but we are in this more or less, if you can see, from 100 to 92. Just forget about this area for a moment. We have been bouncing from up, down, up, down, up, down. We had a shy break there. And this break, if we look at this breakout, past 102 when it was 2% up, this is when it forced the euro through that level, but it was quickly whipped back and below. The price started to fall back below its 100% initial value. Okay, so the index carried a value of 90. So let's start here. As of June 2016, the index carried a value of 93.67, meaning that the dollar had depreciated versus a basket of currencies since the index started in 1973. The index is greatly affected by macroeconomic factors, mainly inflation or deflation in the dollar and foreign currencies that include the comparable basket, as well as recessions and economic growth. So every currency has its own index, pound index, yen index, and so forth. It's mainly affected and impacted by inflation, quantitative easing as well, the printing of money into circulation, and that's what's going to move this thing the most. And again, because this has 58 to 60% correlation with the euro news is also going to move this. And then secondary, the yen move is going to move this and so forth. And then it will go into the other currencies, Swedish krona, Swiss franc, and so on. Now, with that being said, the euro replaced many European currencies previously in the index. So there was a bunch of currencies that were also tied to this index. However, when the euro actually stepped in, all of those currencies went out and it was rounded off by the euro. So again, that's why the euro holds the most value, because beforehand we had a bunch of currencies that all impacted the dollar index and were more or less a part of it, but because all of them went away and it was replaced by the euro is making up for the currencies in which were taken away, if that makes sense. So that's why the euro USD is the major currency pair against the dollar. Dollar's the main currency in which you can spend more or less around the world. And it holds the most significance because of the Federal Reserve has dominance on all of the other central banks. And the euro is the major because it replaced a big group of currencies previously. So you've got the dollar and the euro, huge powers there coming together, which make the euro USD. That's the cheapest pair to actually trade. It's the most confusing at times, but that is actually the story behind it. So again, you can screenshot this, go research it for yourself, but that's more or less all we need to know, to be honest. Okay, so let's get into the technical aspects. Now, what I've done, as with all of the other currency pairs, I've added key levels because from a technical standpoint, we can utilize this to find the overall direction, breakouts, rebounds from the MAs and so on. So I did mention that the symbol I use is DXY because I'm only looking at the monthly, weekly, and the daily time frame on the dollar index. I am not going to be looking at smaller time frames on this. I only look at the monthly, weekly, and the daily just to keep it simple, to be honest, with the dollar index going forward. Now, the levels. So I would like you to plot 100 on. I keep my 100 level, put it on there, put the coordinates in, and keep it to the highest degree, the thickness. Show text alignment right top and right in a 100% initial value, just to remind us. Why do we do that? Because the initial value is always going to be 100. So as I mentioned, that index value of 120 is 20% up. Index value of 80 is 20% down. So it's good to just have that on there, just to remind us. Other than that, key level wise, I do it every 102, 104, 98, 96, and so on. So if you guys can go ahead and do that. Similar, we can do this on the monthly time frame, put all of the levels on, and then just draw a small highlighted area, okay, going forward. And I have levels on down to 86. If it does break through that, 2-minute job, as is all of the key level structure. 2-minute job, and we are done, and we are ready for the next point to the downside and maybe upside. Right, so candlestick formation is the same. Like over here, as you can see, we spiked above, we left a tweezer top, 1, 2, bearish engulfing, and it's also a shooting star. We dipped back, look at the body closed below 100. We consolidated between 100 and 102 for 1-2 months there. Then what did we see here? Same moving average setup. Keep it as thick, the thickest possible, as I went over in the moving average section. But the candlestick formation, shooting star, boom, closed below. So let's say, for instance, let's ignore this 1, 2, 3, 4. Let's say the shooting star closed below the MA. Again, this is all in the MA section. Closed below the MA, closed below 100. our analysis suggests that we are looking for further dollar downside for the coming months ahead. And that's exactly what we got. Over here, if you zoom right in, we have open, spike to the highs, close below, crossover afterwards, but then we have one shooting star, two shooting star, three shooting star, four shooting star, currently a shooting star, however the month isn't over. So what we're looking at now, can you see here, 92? We could potentially see a break of 92 soon. If 92 breaks, we're looking at 90, and we already have our levels on that. Again, because we're not trading this, we're using it as a guidance indicator. So if that does, because we're at 92 now. Now, if you look at the euro, look where the euro is at. Some great analysis on this recently, but the euro is stalling around 1.1925. 1.2 is its next major level. So let's say euro did pull and tap on 1.2, which I believe it will do in the next few days. Dollar index could come down and start tapping on 92. That makes sense. So we've got 92 over here, and then the euro is at its highs. So there's a potential it could rebound. We could maybe even see a slight rebound as a retracement before continuing short on the dollar and long on the euro, or we can break straight through it, force through 92, maybe go to 90, and that dollar weakness will allow the euro to actually push up higher, maybe to 122, and then eventually 12400. Okay. If I go down to the weekly now as well, so again, we want to just combine these time frames. Okay, so weekly, what we've seen is a break back below the 100%. The moving average is crossed over on the weekly, and the market, as you can see, again, moving average section, guys, get that locked down. We have a reverse and rejection, spiking through 8, bearish engulfing, consolidation, spike through, engulfing. We're just getting trend continuation moves. So we use this the same. This, to me, I do see this 92 breaking and going to 90, maybe even 88, to be honest. But because it's down 7.5% from its initial value since April, Euro USD has came all the way back up as well. So we can see a continuation move on the dollar index. I'm using it against the euro at the moment, but if we look at the euro, if we look at the gold chart as well, gold reflects weak dollar. We can pierce through this 1300 now as well. Aussie looking to go higher, sterling looking to go higher as well. They're the currency pairs I use. So to break it down, I'll be looking at the dollar index, studying this, looking for key reversals on the weekly, daily, monthly, looking at the overall trend direction. Monthly moving averages are down, the weekly moving averages are down, daily moving averages are down as well. We can even implement fib into this. A, B, C, D, A, B, C, D, and so on. So when you ever see and study, let's say mainly on the daily chart, because that's going to be the more responsive chart if you follow my guidance and rules as to which time frames to work from, you can see we have a break below. All of these breakers on the daily are continuations. So if you're seeing these dollar continuations, you want to be hesitant at going long on the dollar. You want to look at the Euro USD, GBP USD, AUD USD. I don't personally trade Swedish krona or any Swiss francs. If you do, again, you can correlate it against that. But the euro is going to be the main one. Gold's pretty decent as well. So gold upside. Gold's been going on, since June, July, April. So gold, it's not too correlated as is the euro. I'll say gold probably accounts for around 20% because gold has other fundamental factors that push this higher, even though it's very, very technically based, and it is a very much manipulated pair as well. But we've kind of locked gold down with our technicals and just treating it as a normal currency pair, to be honest, with a close eye on some of the main news that comes out of Australia and China and the mining and stuff like that too. But it respects technicals extremely well. So dollar index, looking at this now, yesterday we had, Friday, we had a big down day. I could even say it broke this little counter trend line. We're looking for another leg to the downside. We know 92 is one of our levels. It can go to 90. It can lose value from where it is now, 92.5 to 90 is 2.5% value, which could assist the euro in plowing higher because this thing at the moment is just unstoppable. MAs are up on all time frames. Last week was a huge bullish weekly closure with an engulfing of 1, 2, 3 previous weeks. So if you are a euro trader, the dollar index is going to be for you. Again, you can go into further detail, do your research online, but I've just highlighted the key point of the dollar index, the best time frames to use it from.